A perfect 9:30 a.m. breakout setup yields a 100% return, while the exact same price action at 2 p.m. results in a total loss. Trading on expiry day requires shifting focus away from price prediction to a strict mathematical countdown. Every options contract has a shelf life that ends at the closing bell. While these contracts lose value slowly throughout the week, that decay turns into a vertical drop on expiry day, with the time value reaching exactly zero by 3:30 p.m. This institutional battleground at the National Stock Exchange is where those premiums are traded. Every Wednesday for Bank Nifty and Thursday for the Nifty 50, millions of retail and institutional positions collide. Two primary forces govern this environment. Gamma expansion creates sudden, explosive spikes in premium during directional moves, while theta decay relentlessly erodes that same premium every second the market stays still. Because these forces are bound to the clock, surviving the day is a matter of timing. You must categorize your trades into specific execution windows where the math is in your favor. The strategy begins by avoiding the first 5 minutes of trade. Entering a position at exactly 9:15 a.m. exposes you to extreme institutional noise that rarely reflects the actual trend. Instead, look for window 1, the golden period for buyers between 9:20 and 9:35 a.m. This opening range breakout establishes a clear trigger zone on the Nifty chart. Meanwhile, the at-the-money premium remains stable. Entry triggers when the index breaches the 5-minute high or low, capturing the initial premium surge before midday consolidation. To make this work, strike selection is critical. When the Nifty moves 100 points, an at-the-money option might jump 60 rupees. However, a deep out-of-the-money option, often called a lottery ticket, may move by only 2 or 3 rupees, with a probability of profit below 15%. This is deemed to gamma. At-the-money options have the highest gamma, making them hypersensitive to the morning's momentum. During this early window, theta decay is still moderate, allowing buyers to profit before time erosion takes over. Even with high momentum, risk management is mandatory. You must set a fixed stop loss at 30% of the premium paid. If your 100 rupee option drops to 70, you exit immediately. The objective is simple. Capture the morning's violent expansion and exit your position before midday consolidation. By 11:30 a.m., the market enters window 2. The initial frenzy has cooled, and the daily trading range is usually well-defined. A break of the morning's high or low here offers a high-conviction continuation trade. But if the index remains within its boundaries, the statistical advantage shifts toward the option sellers. In this range-bound environment, sellers use theta harvesting. By selling options outside the current price, accelerating time decay deflates premiums. To cap the maximum loss, professional sellers buy further out of the money options, creating a defined risk credit spread. As we approach 12:30 p.m., the environment for option buyers becomes increasingly hostile. If your directional target hasn't been met by 12:30 p.m., you must close the trade. After this threshold, the rate of theta decay steepens significantly. By holding a stagnant position into the afternoon, the trader accepts a risk-reward ratio that has effectively collapsed. The required market movement to overcome the mounting time decay becomes statistically improbable. After 1 p.m., the market dynamics shift again. While sudden spikes can occur due to gamma, the underlying math makes new buying positions extremely difficult to sustain. The window between 2 p.m. and 3 p.m. represents the period of maximum time decay. At this stage, theta decay is at its absolute peak. Any premium paid by buyers will hemorrhage value almost instantly. Unless the market moves in your favor the second you enter, the contract will expire worthless. This window is primarily profitable for established option sellers. They use the final hour to harvest the remaining intrinsic value of the contracts as the premiums drop toward zero. To avoid the unpredictable volatility and gamma spikes that occur in the final minutes, all trades should be exited before 3 p.m. This master market clock summarizes the playbook. Use the morning for momentum, the midday for harvesting time decay, and the late afternoon for preserving capital. Mastering expiry day is a matter of discipline. It is about understanding that your edge isn't found in predicting the future, but in trading only when the mathematics of time are on your side.